Welcome back to another Market Insight, this time joined by Dan Goeddel, our COO, here for a few reasons. One, Aaron couldn't make it. Second reason, well, as is our COO, he does a lot with AI and was actually planning to come on this to talk about the advancements we're seeing in AI and maybe the thing he likes the most. He was early. That's probably too generous. He wanted me to say that. Mid to late investor in SpaceX. So with the big IPO, perfect person to bring on to come talk about that.
You know, you only bring me on here when the headlines are amazing, and I'm thrilled to be back, Chris.
So let's start with the why. Why are we even talking about IPOs? And the first obvious example we can do this is run the S&P 500 compared to an IPO index. This is an index that buys the IPOs quarterly, holds them for 3 years, gets rid of them. And the returns on that, they've been okay. You can see they've probably done their job for what they wanted to do. 9% return since inception, big blip up during what you could say was a bubble in this. Maybe we're getting towards that, something we can talk about, but significant underperformance to the S&P 500 because we hear from two sides of this. I don't want exposure to SpaceX, or I do because I think we're going to see the big jump.
That is exactly what it's like on the front lines talking to clients right now. People are either dying to get some exposure and maybe getting a little exuberant, or they're like, I don't want to touch this. And little do they know, it's going to be included in the indices soon. And they're going to have exposure to SpaceX whether they like it or not.
Well, tell me about SpaceX. I don't necessarily follow it. I allocate differently. We'll talk about that. But tell me about the story.
It is the most exciting company in the world, led by the very best entrepreneur of our times. And originally, people were thinking, okay, well, it's got its rockets. It's going to have a monopoly over space. It has Starlink, the satellites that supply internet to the whole planet. But in the past 6 weeks, Elon Musk really changed up the whole game. And all of the data centers they've been building out, they sold $28 billion of compute to Anthropic and Google. And the whole world is compute constrained in this AI boom. And he really wants to be kind of like Jeff Bezos and Amazon had Amazon Web Services in the cloud data era. He wants to supply the compute for the AI era. And there's even rumors he's buying 20% of the Vera Rubin chips from NVIDIA. So he's out to dominate this marketplace. And that's a huge story. And the world is compute constrained, and he's positioned well to win.
It's a fun story. And the way we allocate, you always want to think back to the three buckets, which you know better. Give me the bucket.
The three buckets, very simple. You've got your cash, you got your safety bucket. So maybe think treasuries are kind of like the perfect vehicle for that bucket. The goal is you want to be ready for the next bear market, right? You want to be protected. Next, you have your middle bucket, right? Your market risk bucket. This is ideally, it's the present value of all your spending needs for retirement. So kind of the perfect investment is the S&P 500, which is really tough to beat.
So so when we're running strategies there, we're trying to be similar to the market, yes. Take tilts appropriately, not taking massive swings on big stories necessarily.
Yeah, you want singles and doubles. You want consistency. You really don't want to be taking outsized risk in pursuit of beating the S&P 500. You want to be around it. But that third bucket, the aspirational risk bucket, that's where companies like SpaceX could be considered. And that's where you're intentionally concentrating risk, taking big swings in pursuit of higher returns. And what's so interesting is companies, really the most exciting companies, SpaceX, then you have Anthropic, who has Claude, OpenAI, who has ChatGPT, Anduril, one of the most exciting defense companies in the world. They're not going public until they're $1 trillion plus companies. So a lot of the value of the best really investment vehicles being captured in private markets before they go public.
Yeah, that's why I like to separate. That third bucket is where I want those stories. I don't want to be telling a huge story for something in my middle bucket.
And I think investors are viewing SpaceX that way. What the common phrase I'm hearing is, I'm never going to sell this, or this is for 10 years. This is for my grandchildren. To where people are truly thinking long-term with this investment, which is how you should be thinking for that aspirational risk bucket. You should say, if this is needed in the next 10 years, I shouldn't be doing this investment.
And I agree with that. The hardest part about that is a lot of the comparisons are $100 billion IPO, a market cap. We're talking about something that IPO'd almost at $2 trillion and trading yesterday. I don't think we mentioned it. Today's Wednesday, 17th. And the IPOs we've only had 3-4 trading days of how it's so far. It's been up every day. It's been a well-priced IPO. The investment bankers did a good job of engineering that early pop that you often see for these IPOs. And it really gets us to who's going to be doing the buying now. And you kind of talked about it. It goes in index funds.
I am concerned that where it's trading and the price is starting to get divorced from reality a little bit, though. I think people that missed it in the private markets maybe didn't get an allocation at the IPO price 135. Now it's trading in the 200s plus last time I checked. You need to be cautious. What I would consider if you have to get exposure is talk to your advisor, about, hey, the next time there's a market correction, the market's down 10% or a bear market down 20% or more, this could be on your list of buys to consider in that third bucket. But I'd be cautious entering now.
Well, let's put the data to that. This is a chart, well-timed, 20 of the largest IPOs the last 20 years and their drawdowns. Now, some of these were successful. I mean, we have Meta. It had a 53% drawdown in its first year. Well, you just explained it. Could SpaceX hit this? Pretty easily. It's already up 50, 60%. Yeah. So just to pull back to the IPO price, you'd make this chart, even though it could be considered still a successful.
Well, the one I think about is I go back to Amazon, right? Amazon Web Services. There's so many things in common. Think about what Amazon just did to general infrastructure. There's so many similarities with SpaceX, and Amazon had a 90% drawdown in the dot-com bubble. And kind of the most predicted bear market of all time is this AI bubble bursting. And I would imagine SpaceX would be punished if that happened. So will you get a better entry point than $200 plus? Probably, but if you're going to throw it in a drawer and never sell the stock, maybe that's a whole different conversation.
The hard part is just the size, $3 trillion versus these, and you compare it to Amazon, a lot smaller during those comparisons. But let's get to who's going to be doing some of the buying, because that's part of the reason you get these big pops. Goes back to a term you've probably seen, it doesn't affect your daily allocation, is float, just the amount of stock available to the public. So a good comparison I think is actually Meta. You have a lot of that insider shares go back to the movie, from The Social Network. Those guys' shares are not floated. Those are insider shares. That's not going to be taken into your weight. Or Elon owns 40% of SpaceX. That's not taken into your float, because that stock's not available. So it's not taken as a weight. So Meta today, $1.5 trillion market cap, about 2% of the S&P 500. SpaceX already well over $2.5 trillion. If it got taken in the S&P 500, its weighting would be 20 basis points. This chart would be a little outdated where it had it at 12. Yeah, that's really small.
The hype piece of this is super real. Like, people are talking about the TAM, the total addressable market, and tens of trillions. People are getting carried away for sure here.
But the indexes, the methodology protects you from a big allocation early. So the S&P already decided they're not adding these for a year, which is their standard process. But then you have to look at, what is the S&P's goal? The largest U.S. stocks that are available publicly, I want it in there. If it's one of the largest publicly available stocks, it should be in there. Or you go to NASDAQ, they've adjusted it to weight them more aggressively. People buy the NASDAQ for aggressive tech exposure. Yeah. I have no problem with the NASDAQ putting a significant weight in there. Yeah. And so those are the issues, because a lot of people are asking us about, well, I don't want to hold it. I don't want it showing up in my index funds. It's going to over time, because that float comes available. Shares in the venture market, they'll start selling in 6 months.
Well, the float is key. You said earlier they engineered the outcome to be a great IPO, right? So they created artificially low supply. All the insiders and employees can't sell. They're locked up. But that supply is going to come online, right? So I think 12 months from now is the big unlock.
Yeah. There's unlocks every few months is how these work. And usually at 12 months is when, besides for some of the big insiders, you have the full float available, with the exception of usually the people running the company, which is significant. It's going to be fun to
watch it. Like, the story is just getting started, and it's going to be extremely volatile. There's no way around it, but I think the next bear market we have, the stock is absolutely going to get punished, and that's probably going to be the best entry point investors have, and that requires patience.
So to close out just the supply in general, so far we've had SpaceX, OpenAI and Anthropic have started their initial filings to also come public, and we have the slide showing how much they want to raise, somewhere around $60 billion. SpaceX raised $75 billion. The next part of the slide is that float. That's how much that would be available. Early on, it starts really low. works its way up to 60 to 80% generally available. And you can see on the right how much it goes into those indices. And the concern that people have had, there's a lot of concerns that we talk about that we think are unfounded and make no sense. But the supply concern is real. What ends bull markets is generally big supply of new issuances, along with tightening of credit conditions, raising interest rates. So we have the first part, we have new supply. So far, again, it was only 4 days in, markets absorbed it really well. The main thing you'd see around these periods would be those sell-offs get magnified. It's exactly what we saw last week. There's a little sell-off. We said last month we'd probably see a sell-off just because of how fast markets have moved up. Can never predict what caused it. What actually caused it was a really good jobs number, which is counterintuitive, of course.
I hate when good news becomes bad news for the market. I think whenever that's happening, you're in this silliness of short-term thinking. That's kind of taking control. And over the long run, that's going to get worked out. But it kind of makes me think that investors are skittish. Like maybe we're not in an exuberant period like 2021, the SPACs and just how much gambling entered the market. It makes me optimistic we're not in a period like calling the market top yet. But it's going to be interesting to see Kevin Warsh. It's showtime today for him.
We're not in that period at all. It's very isolated to areas within semiconductors where the demand is a lot larger than anyone expected. With the exception of CO2, they did a pretty good job of predicting that demand would be there. But most people did not, and that was a big run up. And you could argue that part of the market got a little euphoric. But other than that, as being widespread to a market, I'm not concerned at all. The same reason when we take this, when we talked about the supply coming on, market handled it really well. There was not huge sell-offs and actually started to rally as some of that appeared to go away, those concerns they left. But as you said, Warsh is the big one. And the fear is always that when a new Fed president comes in, there hasn't been that many of them. We got a handful of them on the chart here. Is they're going to do something different that spooks markets.
Well, plus we have a midterm election year. But Kevin Warsh is an interesting character. I mean, he's really an elite insider. His wife is Jane Lauder, the billionaire heiress of the Estee Lauder fortune. He's done pretty well himself. And what's so different than Powell is he really, his communication approach to markets, I think, is going to be way quieter. Like, I think he is going to want to not show as many of his cards, give less guidance. He wants to maintain more flexibility. And I think some of that might actually be really good for markets. In the piece, I think he gets, which Trump likes because it probably means lower rates, is he really thinks this AI era will translate to deflation. And it's going to be a massive productivity boom and deflationary force so that the Fed is under a whole new paradigm. So maybe the decisions Powell made, he won't be making the same way. But the market's going to test the Fed chairman. You know, Tom Lee at Fundstrat always says, we got a midterm election year and we got a new Fed chairman. The probability that the market gets tested from this point now between midterms is pretty high. Like, back to everything else we're talking about, if you're a client or prospective client, one thing I would be doing is using the good times to prepare for the bad. The main thing being getting your cash in that first bucket right. Getting bear market ready now at all-time market highs.
I hate the term test the Fed chair. Yeah. The market, I think the cause and effect is wrong. The market struggles because there's new information. They have a hard time repricing it. The good news this time is the market from the war is pricing in Fed rate increases. Entering the year, it was decreases. Then you get the war, you get an inflation spike, oil, energy prices up. Well, we got that starting to get behind us now, which we can get into. But he's taking over today with expectations of rate increases, which is great spot to be, because the surprise would be, no, we're actually, when we look at it, we say there's no reason to do anything right now. Once some of the disinflationary forces show up, you can probably cut rates a couple times.
I think that's how it's going to play out.
And the fear was, and you talked about his history, he's a conservative guy, which used to be the view of higher interest rates, right? Harder money, not lower interest rates like we've seen lately. And so that's the fear. But now he's changed that tone. I mean, he left the Fed after the GFC. He was a governor at the time because he didn't like the bond buying they were doing. But, 15 years ago, things change. His view has changed. He's clearly convinced the president that he doesn't necessarily believe in that anymore, that he's going to be extreme hard money. The view is that he wants to cut rates and reduce some of the bond asset purchases that they have on their balance sheet, which should probably be fairly neutral, if not a little bit bullish to some deregulation within the bank.
Yeah, I think he's much more worried about AI and productivity leading to deflation than Jerome Powell was. I think it's going to be a breath of fresh air, and he's the right man for the era.
I think that's a great point. I mean, Powell, the amount of time that Powell would mention AI was really just if people asked him at the press conferences. It wasn't something he would really go to until maybe the last few quarters. But it was something that we always said, he's not taking this into account with the committee. Now, that's the other part. Can Warsh get this stuff through committee?
Powell's hanging out, protecting himself from potential lawsuits. And is he going to go along with the new Fed chairman, or is he going to be some internal resistance?
I think Warsh is a professional. Once he realizes that Warsh is in there running these meetings well, he's gonna feel fine that he can step away, and he should have. That's wild staying around. Precedented because one other Fed chair did it a long time ago, but typically they step down. As we said, the backdrop that Warsh has now is people have been talking for months about him coming in there with oil prices up significantly, and they still are, but we're down 25% from the peak in oil prices over the last month and a half.
It seems like the Panikins are wrong yet again. I'm shocked, Chris.
Yeah, the Panikins got a lot wrong about the war, and we got made fun of. We don't have a big enough following to get directly made fun of, so we got made fun of for having this playbook of the Trump conflict playbook, which we've seen multiple times, which is just he comes out, he pushes as hard as possible, escalates the war, extreme volatility, unpredictable. We're gonna hit the power plants, we're gonna hit bridge day, and then we pull back. We have a resolution and markets rally. Constant thing we've been seeing. We kept going back to it. Got pushed, got called that it was a silly playbook. We knew it wasn't priced into markets just by seeing sentiment online of how many people disagree with this. So we kept going back to this playbook as the likely resolution. And it's exactly what played out. The timeline got elongated. It was 40 days of war, 60-day ceasefire, and now we're entering another 60-day ceasefire that hopefully by the time this is released, we do have official signing of that understanding on Friday. But at least now that's what we're pricing in as at complete de-escalation and back to...
I think Trump's ready to move on. I think Israel very much does not want to move on. They've been the big winner in the war so far. And you really have to step back and separate two things. One, did we achieve military victory on the battlefield? And I think we absolutely dominated. I think U.S. dominance militarily is totally reestablished and unquestioned after this year. I mean, go back to Venezuela at the beginning of the year. The piece that is totally unsettled is, well, are we going to get a diplomatic victory? And to me, the hallmark of that will be, are they going to continue to pursue nuclear weapons or not? That's the stated whole reason for this war. Otherwise, all we really achieved was we just degraded their military and we're kind of back to where we started, which kind of makes you question, was it worth it? So it still is playing out, but I think in terms of markets and the Strait and oil prices and all of that, I think the risk is going down substantially.
I always go back to Russia-Ukraine of 22. The longer we get used to it and things change, as long as we get some more oil flowing through, obviously we've been drawing down on reserves for obviously 3 months now. As long as we start to get some of that oil flowing, markets aren't going to care about this.
The U.S. is totally energy dominant now. And think about how when the Strait was closed, what we did to get oil to the rest of the world. And we couldn't have done this 10 or 20 years ago. And I think a lot of people were operating under that paradigm, like, the global economy is going to have a depression because of this. And that wasn't the case.
I don't get involved in geopolitics too much, but you're here. So I think
I'm trying to draw you in.
The Panikins underestimated the force we had with the blockade, the reason that Iran would want to stop. And we had some help from some of their neighbors trying to get in there to say, hey, come on, we need to move past this.
Yeah.
And that's probably what they also underestimated to get to at least an agreement.
Yeah, I think one of the biggest learning lessons for investors over the past decade, one, don't listen to Panikins, and two, don't bet against the U.S. And there's been so many opportunities to panic. And we went back last year, and if you just missed the best day in the market in April during the tariff trade war, you would have had no return for the S&P 500 for the year. So,
and I like your takeaways. Mine would be go back to the 3 buckets. Our first bucket was full. Obviously I don't hear every client communication, but I didn't hear a whole lot of complaints during the drawdown of the war, as in, hey, we have plenty of cash. We were prepared for this. We know this kind of stuff happens all the time in terms of 10, 15, 20% market pullbacks. We're ready. Yeah. And now we're starting to recover. So now it's time to refill some more cash.
That's right. Let's use the good times to prepare for the bad yet again. That's what we do.
To close out the Panicans, because this was actually based on an article that you wrote. And the one thing we've disagreed with a lot of it, one of them that has some validity is the ETF, is the supply. Because one of the Panicans does talk a lot about that. So just to be fair, I don't agree with a lot of what they said, but we did highlight one of their rationale for why things could struggle. And I think because of how slow that float comes up, like we said, we're not going to see extreme issues from that issuance. But of course, just like anything else, bond issuance goes up, I can make interest rates go up and can be troublesome. Same thing could happen with equities.
Letting your politics, your ego get in the way of your investment decisions crushes wealth. And it sounds so cool to be bearish and to say the next crisis and try to call it, be the guy in The Big Short. But the reality is we're kind of in an unprecedented era of this AI revolution, and most of the experts say we're in the 3rd or 4th inning. We're still early. Don't lose sight of that. Just because there's some headlines and somebody who's really smart and well respected is getting you whipped up, because most of those guys are actually net bullish in their portfolio as they say those things.
I think 3rd to 4th inning is a good estimate. I go back to Anthropic made the chart, but this framework from the CMT Association of just, are we in a bubble? Because they all follow some similar path. It starts with a new idea. They call it displacement. Of course, AI is going to lead to a bubble at some point. And you're backed by credit creation. Is money flowing? You really need extreme money growth to really create that euphoria that comes before you have issues later up to implode within the bubble.
Yeah, I mean, if you go back to the dot-com bubble, it was fundamentally caused by dark fiber, right? All the cables that were put in the ground and ultimately weren't used. There was too much hardware. There was too much CapEx, too much investment, too much exuberance. You could see the dot-com bubble similarities in where we're at today with data centers, but I think we're so early from that. People forget how long the bull run leading up to the crash in the dot-com bubble was.
The way you would get that anytime soon is if the growth from agents, AI actually not being a chatbot, but actually doing work for you, if that for some reason doesn't work, doesn't take off, we're probably overbuilding. And the credit side, and this is something we want to see. It's a good backdrop for the economy, and stock market, of course, is money creation through whether it's central banking or bank lending. We're under 5%. We're under the long-term average. So as far as saying we'd be concerned that this would spark euphoric market behavior, it isn't. The other one that they like to throw in is actually margin debt, people buying stock with borrowed money. And there's a lot of chart crimes that come from this when they just post how much margin is out there. So a lot of people, the Panicans would do that. You have to at least put some angle to it. You have to put a denominator with it, which would be the percentage of market cap. Margin debt as a percentage of the size of the market is actually down significantly. It's around 1%. Well, typically it's going to average more like 1.5. So there are two metrics for measuring, is credit really pushing us over the top? It's not there.
Yeah. And I think if you look at the volatility this year, I think the general tone is we're climbing the wall of worry. I don't think we're in that exuberant stage yet, but we shall see with the IPOs of OpenAI and Anthropic coming out. Maybe that changes.
And so far, a lot of the big moves are rotation. So we'll see tech move and the industrials and other parts of the market sell off. We're not seeing a massive move higher. I mean, the S&P was only up 10%. That's relatively contained. Of course, some indexes are up a lot more than that, and you get concerned. But as far as it affecting broad portfolios, no, not concerned. Is there anything else you're really hearing on the client side about how we should be approaching some of these topics?
The main conversations we're having is using these good times to prepare for the bad. That first bucket, that safety, that recession and bear market readiness. Talk to your advisor about getting that in place. If you're not having those discussions right now, you need to be.
Well, thanks for joining, Dan. Join us next month, and we'll hit some more of these topics, see what's new with the IPO calendar, and hopefully have the ending of that memorandum with Iran finished. See you then.